As we begin now for the first one after break, we will start with Alice, who is going to go through the some 340B updates for us. And very briefly, Alice is a partner at the law firm of HOGAN and Lovells, where she represents pharmaceutical manufacturers in relation to their obligations under the Medicaid rebate program, 340B program, and the ASP reporting program. So everybody, please welcome Alice.
Good morning, everyone. So because CMS was not able to attend today, I'm going to try to do my best to summarize a little bit about where we are with the ACA Proposed Rule. I also want to take a little bit of time to talk about what CMS also has been doing this year, which is spending a lot of time on these price transparency initiatives with NACP and my least favorite acronym of all, NARP. As well as federal upper limits. And then, since I only had some sense from Commander Pedley what she would say, I'm going to talk some about 340B and skip over stuff that I think she's already covered. So, first, the ACA Proposed Rule and timing. When will it be finalized? Well, when CMS issued the proposed rule in this year, I mean, doesn't it seem like a long time ago? I got to tell you, March and April, or February and March were like dog years for me. There was so much to go through in those rules. But they said that it would be finalized in 2013 when they released the proposed rule. But when in 2013? And the simple answer is it depends on who gets elected. If Obama's reelected, my guess is that, and it's just a guess, is that we'll probably see it earlier in the year. My guess, again, would be that CMS will probably have it pretty much in the can, or at least have a pretty good idea of where they want to go so that they could release it quickly. If Romney's elected, then it's later in the year, if at all. And it's later in the year if they don't repeal health reform. If you listened to the news yesterday, all of a sudden he's saying there's some parts of health reform he'd like to keep. But depending on what happens legislatively, that will obviously impact it. But even if it is repealed in some important respects, the question is, what about the housekeeping aspects of the proposed rule? Remember, the reason the proposed rule was so massive was because it addressed not just the ACA issues, but also a whole bunch of housekeeping measures that you had to give CMS credit for, sort of tracking over time and realizing, these are issues that we need clarity on. And those issues include things like expansion of the program to the territories, cleaning up and revising the coupon and patient assistance program criteria, what does it mean to be an original NDA for our innovator and single source drug categorizations, revising and harmonizing the BP regulatory definition to the statutory definition, and also and last but certainly not least, the bundled sale clarifications. There were a bunch of issues in that rule that had nothing to do with health reform. So regardless of what happens on the health reform front, it's still possible that CMS could move forward with a pared down rule that addresses all those issues. So those issues I just mentioned, I'm not going to talk any more about yet, but they were addressed and will be addressed through various of the breakout sessions today. So for example, John Shacko did a session yesterday where he talked about the bundled sale issue. There are breakout sessions that will be talking about some of these issues, and if you are interested in them, you should look at the agenda and go there. So, what do you do in the interim? Well, remember that statutory requirements, the statute itself is enacted and is binding. So you do have to comply with statutory requirements. What you don't have to do yet are sort of the unclear things in the statute that the regulation would make more specific. But anything that's in the statute you have to comply with. And where it isn't clear, that's where you make reasonable assumptions to fill in the gaps. And actually, Ben Martin from Epstein-Becker is going to do a breakout session later today where he's going to actually talk about what do you do in the interim. And so if that's something you're worried about, you should attend that. But last but certainly not least, you should take the time now in your copious free time and really keep track of what were the issues in the rule. What are you doing on each of those items? If you commented on them, what they were, so that when you get that final rule, you are ready to act. Because believe me, when that final rule comes out, your management is going to want to know immediately what this does for your business. And you will have plenty of time until 2013 to actually get your house in order if you don't already have it, and create a nice chart or some other list that keeps track of each issue in that proposed rule, your position on it, what you might have to do if it goes a different way, so that you're really ready to hit the ground running once it is released. All right, so what are the key issues? The default rule. Never has so much paper been written about a more boring topic in my life. Did any of you try to explain what the default rule was, and you got 5 minutes into it, and they still would say, I don't understand, right? But it's obviously very important to both the operational issues of how you calculate your numbers, but as the comment letters made clear, whether you use the default rule or the build-up approach will absolutely impact where your AMP ends up, its volatility over time, really whether it's accurate, whether it's a number you can certify. If you looked at the manufacturer comment letters on this issue in general, there was just incredibly consistent opposition to the CMS proposal to move to the build-up approach rather than the default rule. And this is a great example. There was a comment earlier during Paul Begala's speech about does the president get the rulemaking process and why it's so important. The default rule is a great example of what the rulemaking process is supposed to be about, because CMS comes out with a proposal and everyone just looks at them and says, are you crazy? This makes no sense, and it's the stakeholders who are closest to the issue who can weigh in with the specifics and really educate the agency about why this proposal makes no sense from any direction that you look at. And you know, CMS, to its credit, I think, wants to hear those things. I tell people all the time, you really can't underestimate the ignorance of the agency on a lot of these operational issues. Not their intelligence. They're very smart people, but they aren't in the weeds on these calculation issues, and so they can make these proposals and have no idea what the impact is. And that's exactly what the rulemaking process is about, and believe me, they got an earful on that issue. And most importantly, there was a joint stakeholder letter by a bunch of trade groups, Pharma, Bio, HDMA, and NACDS, that sent a joint letter to CMS that said, we absolutely need to keep the default rule. And it's because of that consolidation across both manufacturers, wholesalers, and the pharmacies that I am cautiously optimistic that CMS will keep the default rule. We won't know until we see the rule, but it was the pharmacy lobby that was really concerned about the default rule. And so where NACDS, which is one of the two main trade groups, comes out and says, you know, now that we've learned more about it, we're actually okay with the default rule, I think that's going to be a pretty important indicator to CMS about where to go. Another issue, the definition of retail community pharmacy. So they basically adopted the very narrow definition of retail community pharmacy in the proposed rule, but they also proposed to include in the traditional non-5I AMP calculation those entities that are quote-unquote conducting business as RCPs. And it would include specialty pharmacies, home infusion pharmacies, and home health care providers. Why did they do that? Well, because they realized you can have products that are not infused, injected, implanted, and blah, 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 but that aren't dispensed through true bricks and mortar retail community pharmacies like CVS and Walgreens. And those are basically, you know, expensive oral products that go through specialty pharmacies. And they realize that if they don't expand traditional AMP to include those types of pharmacies, there is not going to be an AMP available for those products. So they said, well, we're going to include RCPs, and then we're going to include those entities that basically act like an RCP for that segment of the industry, and that solves that problem. Bona fide service fee. There are actually a couple of really good presentations on this issue yesterday. CIS did one, so did Huron. Should look at those slides if you can. The interesting thing about the bona fide service fee definition is that the ACA opened the door for CMS to conclude that on a broad basis, service fees that met or could be called by certain names were de facto bona fide in all circumstances. Because the way the amended statute reads is that AMP excludes bona fide service fees such as distributor service fees, inventory management agreement fees, and there's this long laundry list. And so when that came out, everyone was wondering, what does that mean? If it has that name, do we need to treat it as a bona fide service fee? And what was so interesting about where CMS went is the door was wide open. They could easily have gone there, and CMS absolutely refused to do so. CMS said, you know what, we're not going there. We still want you to have that qualitative evaluation of service fees because we're worried that they could be hidden discounts. We're still worried about AMP being too high. And so you still need to do that qualitative evaluation of these service fees. Those service fees that are in that laundry list certainly could qualify as bona fide service fees if they meet the definition, but you still need to do that qualitative analysis. And that, I'm not saying I was that surprised by that, but it was an interesting rejection of this clear opening in the statutory language to move that way. The other thing that you absolutely need to look at in that preamble discussion is about a sentence worth of commentary that CMS has on price appreciation credits, which by and large I think are fairly common in wholesaler agreements where manufacturers sort of offset the service fee that they're going to pay their wholesaler by the amount of inventory appreciation the wholesalers realize on inventory that's on hand at the time a price increase is taken. And CMS has some language in there that is a little confusing, but since almost everyone has an agreement with price appreciation credit language in there. It's absolutely something that you should be looking at a little more closely and probably talking to your lawyer about, just to make sure that you're addressing it in a way that minimizes risk, given that CMS has now called that out in the preamble. Authorized generics. This is an issue that John Chacko talked about in more detail yesterday in his presentation. At a high level, it's all about AMP, right? When CMS did authorized generics in the DRA final rule, they said that for the typical authorized generic arrangement where a primary manufacturer sells at a transfer price to a secondary manufacturer, and the secondary manufacturer then sells the authorized generic, that transfer price transaction is not eligible for AMP. It's eligible for best price, but it's not eligible for AMP. And what that would mean is that the branded products, AMP would stay really high based on the branded product's own sales, but the BP would totally tank because it would be set by this transfer price. And the reason CMS said that was the requirement of the DRA is because the DRA didn't change the definition of wholesaler, and wholesalers didn't include other manufacturers. And this was a sale to another manufacturer, so you don't get to count it in AMP. Well, guess what? The ACA includes a new statutory definition of wholesaler that's incredibly broad and arguably has the potential to be read to include those manufacturer-to-manufacturer sales. And manufacturers were a little worried about whether they could do that because it's really just going to lower their AMP, which is going to lower your rebate, and that is exactly what CMS didn't want to have happen under the DRA. When you look back at the DRA final rule and why CMS decided not to allow AGs to be an AMP, they specifically said, because if we let you have them in AMP, it's going to lower your AMP, which is going to lower your rebate, which is exactly what Congress didn't want. So lo and behold, now we have the ACA that would let us do that, which would lower our AMP and lower our rebate, which Congress usually didn't want to do, but I think was sort of an oops maybe that people weren't thinking about with this new statutory definition. So I think a lot of manufacturers were unsure about whether they could really move forward with this. So far, CMS seems to indicate that maybe you could. They've addressed that issue specifically in the proposed rule. Now that said, we still need to look at the default rule decision to see how this is going to play out, because if there's the build-up approach, you don't get to count the transfer price transactions in your AMP unless you can prove that that unit ended up going to a retail community pharmacy. And even if the default rule stays in, it still probably will require that you are comfortable that the manufacturer to which you are selling that product is acting as a wholesaler that sells to RCP, so you're probably going to want to have some comfort that that secondary manufacturer is selling to RCPs, even in order to support the default rule approach. So while it's looking positive in the direction CMS is going, you need to wait and see what the default rule decision is, because that could implicate exactly how you could count those transactions in AMP. And the other thing you have to look out for is I'm not sure that the retail community pharmacy lobby has woken up to this issue. Remember, their big issue is lower AMPs mean lower fulls, and they want the fulls as high as possible because that's going to be their reimbursement rate. And once they realize that this authorized generic issue could result in AMPs being lower on drugs that by definition are going to be multiple source because it's an authorized generic, so you have a generic entrant, and that you're going to end up having a really low AMP for the brand, they're going to be worried about the fulls. And so I think there's also this wild card issue of what are the retail pharmacies going to do? Are they going to push back and try to get CMS to back away from this interpretation? Next issue, 5I not generally dispensed through a retail community pharmacy. So remember, this is another oops that actually Congress fixed through statute, because the original definition of AMP, since it was limited to just RCPs, meant that there was no AMP for products that weren't sold through RCPs. So about 6 months later, they amended the statute to provide an alternative AMP formula that frankly looks a lot like ASP for 5I drugs that are not generally dispensed through RCPs. It's not hard to figure out if your drug's a 5I drug. What is hard is to figure out whether qualitatively it's not generally dispensed through a retail community pharmacy. The proposed rule talked about that. They proposed using this 90-10 determination of whether, and I always get turned around on this, but I think it's if you have 10% or more of sales through retail community pharmacies, you don't pass this test. So you have to have less than 10% to be not generally dispensed through an RCP. The manufacturer comments on this really ran the gamut, and there's really both a quantitative and qualitative standard that they're looking at. Quantitatively, manufacturers, for obvious reasons, like having a really straightforward, bright line test they can use to determine whether or not their drug satisfies this standard. But there are a lot of folks that thought 90-10 was a little too stringent. They wanted either 75-25 or 50-50. And some manufacturers also think a qualitative test should be at least part of that determination. And there also was widespread opposition to CMS's proposal that you actually had to redetermine whether something was not generally dispensed through an RCP on a monthly basis. Can you imagine having to make that determination on a monthly basis? And so there was also widespread support for moving to an annual, or if not annual, at least a quarterly basis. Now, why should you care about this? Well, just strictly from a quality of life perspective, you don't want to have to move your calculation for a drug month to month or even quarter to quarter between one formula or another, because life is too short. But there are actually really good policy reasons for this, right? There are both rebate and federal upper limit reasons for wanting to have some stability in the formula that you use for calculating your number. Because if your rebate could float significantly, if your AMP is going to change a lot depending on which formula you use, that means that your rebate could change a lot depending on the formula you use. And then a state's rebate amount for a drug could change enormously just depending on when they paid the pharmacy for your drug. So from CMS's perspective, I would think they would want states to have a relatively stable rebate rate with not a lot of fluctuations so that they don't either lose out or have a huge windfall depending on when they pay the pharmacy. The other, probably more critical reason is federal upper limits. The AMPs are now going to be used to set reimbursement rates. There's stuff in the statute and certainly CMS statements about wanting to have smooth reimbursement rates once they roll out federal upper limits. You're going to have enormous volatility if you are changing your AMP formula on a monthly basis. And then what do you do for your quarterly rebate, where you average your 3 monthly AMPs for the quarterly number? And what if 2 are in one formula and the third month is on the other one? It's just nuts. So there are a lot of really good reasons, as opposed to, in addition to quality of life reasons, why you want to have stability in that, and having a more generous quantitative standard as well as a less frequent determination both add to that stability. An interesting twist on this issue is, remember a couple slides back where I talked about retail community pharmacies and those entities conducting business as retail community pharmacies? Well, for this quantitative test, you have to determine how many of your units are going through the retail community pharmacy channel. And the question is, how do we treat the conducting business as entities when we're doing that 90-10 or 75-25? Do we treat them as RCPs or do we treat them as non-RCPs? And that could move the number quite a bit. And so that's also something that CMS needs to address. The line extension alternative rebate formula. So this is the alternative rebate that applies to line extensions. And CMS really came out swinging on this one. They basically threw the kitchen sink into the definition of what is a line extension. And what was most troubling is they said, well, we have to define line extension, and we have to define it broadly because Congress didn't. Well, that actually made me go back and look at the statute, and guess what? Congress did define line extension, and they defined it very specifically as a new formulation, such as an extended release formulation. And so not surprisingly, manufacturers hit back pretty hard in their comments saying, you're going way beyond your statutory authority. This should be new formulations only, and frankly, it should be a subset of new formulations. And in particular, manufacturers of combination drug therapies and abuse deterrent and new drugs that include abuse deterrent technologies, which are great public health supporting drug formulations, went to CMS and said, you've got to be kidding me. This is like a public health priority for us to develop combination therapies, for us to develop controlled substances, for example, with abuse deterrent technologies. And now you're going to penalize us by making us have a bigger rebate? Didn't you get the memo? Didn't you talk to someone else? And so again, this is a great example of why we need this kind of thing to go through rulemaking so that stakeholders can educate the agency about issues that they otherwise might not be sensitive to, but that obviously the stakeholders are because they deal with it every day. MCO rebate expansion. There was a lot of stuff in the proposed rule and comments to it, just about the mechanics of how we get those invoices. The good news is that we haven't had to wait until 2013 to get that guidance. CMS released a paired manufacturer and state release on the mechanics of how these claims are going to be identified in your invoices. So if you have not looked at those releases, you should do so. CMS also clarified that the effective date is for drugs dispensed on or after March 23rd, 2010. We didn't know if it was drugs paid for or, that could have been dispensed before that date, but they've made clear it's after March 23rd, 2010. And the next issue I want to spot for you is an issue that I haven't heard a lot of people talking about, but it is an issue that I think is going to be relevant for at least some of you. And that is, remember that the whole reason that you participate in the Medicaid drug rebate program is so that Medicaid has to cover your drugs, right? They can prior authorize the heck out of them, but they have to cover them. And that's always been the rule on fee-for-service Medicare. So now they've expanded it to MCOs. So you would think that now MCOs have to cover your drugs too. They can prior authorize the heck out of them, but they can't refuse to cover them in all circumstances. Guess what? CMS says no. They can, I think their euphemism was, we're going to allow MCOs to maintain flexibility in their formulary arrangements. And if this is an issue for you, I will tell you, you should go talk to your lawyers, because I'm not sure, CMS certainly hasn't articulated any legal basis for that interpretation. And if this matters for your drugs, it could make a big difference to your bottom line, because MCOs, it really would open a market for you that you might not have been able to access before. And so if that is an issue for you, I encourage you to look at that issue a little more closely. Expansion to the territories. You know, what's interesting about this issue, in addition to being at 20 years late after the creation of the program, is that it affects both the utilization that is subject to rebate as well as the sales and discounts that are eligible for your calculations. And at least in my experience, it's not that manufacturers don't care about the extra rebate liability they're going to have on these extra units, but it certainly was a common theme that I heard from manufacturers that their concern is less about the increase in rebate liability than to the enormous operational implications of having to start including sales and discount transactions from the territories in their calculations. A couple of interesting examples. What if you're a company that has a separate subsidiary that sells into the territories? Now all of a sudden you have to get their data, make sure they use the same classes of trade, the same transaction type markers, and then start importing that, and just the operational difficulties of doing that. What if that separate subsidiary sells under a different labeler code? So it's the same drug, but it has a different NDC. Do you have to start now reporting on those NDCs? Do you have to do a blended AMP and BP across those NDCs for the same product that are sold? God, I keep doing that. That are sold in the two different areas. I mean, just, it's painful. But once you start thinking about it, you'll be like, damn, there's that, there's that, there's that, there's that. Huge operational issues. And then there's also the issue of, in Puerto Rico, there are some mandatory discounts on certain products, and usually those sorts of arrangements are excluded from the calculations. And shouldn't they be excluded now? And so those were the types of issues that manufacturers took back to CMS and said, you know, you haven't done this for 20 years, don't start now. There are all sorts of issues that you're going to have to iron out if you want to go that way. That is the ACA issues in a very small nutshell for you to be thinking about and where CMS came out. Now, just as OPA has had a very busy year doing a lot of initiatives, CMS has too. And with that, I'm going to talk about their NADAC and their NARP initiatives. You know, every time I say that, I feel like I'm some character in a cartoon. NARP? NARP? Anyway, so NADAC is something that they've been talking about for a while, which is this nationwide survey of invoice prices paid by retail community pharmacies for covered outpatient drugs. So any drug that's in the covered outpatient drug file, they're going to be surveying retail community pharmacies, not specialty, not mail, I'm not even sure conducting business as entities, just true RCPs, and asking for their invoice price. And invoice price matters because while they call it an acquisition cost survey, it's really an invoice price survey. They're not looking at rebate data, contingent free goods, anything that's not on the invoice they're not seeing. So they're going to start doing that, and that matters because while, or the single source drug piece and the innovator multiple source drug piece matters because, you know, the innovator manufacturers of the world have gotten the benefit of not a whole lot of price transparency for a while. The multiple source drugs, non-innovator companies are used to fulls being out there. But if you're a single source drug company, no one really knew how you were pricing your product other than your WAC that was out there. You're going to have a NADAC for your product. And yes, it's just what the retail community pharmacies are paying for your drug, assuming it's an RCP drug. But it's still a price point that was not out there before. What CMS proposed more recently is their national average retail price survey. And they're going to use the same vendor. And this is going to be a survey of consumer prices. So what are consumers paying at the prescription drug counter to get their prescription filled? And they're going to break it out by market segment. Cash payers, commercially insured patients, and then Medicaid patients. And what's scary about that, I think probably most scary for retail pharmacies, but there's a reason why manufacturers won't like it, is all of a sudden you're going to be able to see on average what the retail pharmacy spread is. Because you're going to see their invoice price and you're going to see what they're charging people. And I'm just waiting for Consumer Reports to start looking at this data and start talking about the chains that, you know, just, they're going to use this in a way that at least some people won't like. And again, they're going to do the NARP for single source drugs as well as innovator multiple source drugs and non-innovator multiple source drugs. So even if you're a single source drug company, People are going to be able to look at what your retail pharmacies are paying for the drug and what they are turning around and charging consumers for it. And then, of course, if you're a multiple source drug, you're going to have federal upper limits, which are already out there. Although when I checked over the weekend, the full link on the Medicaid website was down. I'm assuming that's just temporary. And what CMS wants to do, and it really is innovative, and I think you have to give CMS credit for creating this out of nothing, right? They really just took this initiative on, and they are going to make it happen as a way of driving reimbursement rates down to increase savings at the state Medicaid level. Is they're going to array these price points for each drug. And so you're going to be able to see what is your NADAC versus your NARP on a monthly basis, and if you're a multiple source drug, how does that compare to your federal upper limit? And then here's the kicker. They're going to get from the states on an annual basis what the state's reimbursement rate is for their drug, and then they're going to compare it, and they're going to rank states by cost effectiveness, which is another way of saying we are going to put at the bottom of the list the states that overpay the most for drugs from CMS's perspective. They're going to look at what's the reimbursement rate for this drug versus what the pharmacy's acquisition cost is versus what commercial payers are getting able to pay for this drug, and then look at how much is the state overpaying. And I think what you're going to end up seeing is a lot of state-by-state pressure and lobbying around this issue with the retail pharmacy lobby. And what I encourage manufacturers to do is just know these data are going to be out there. We don't want you caught flat-footed. We don't know how you, your competitors, or your customers are going to use this. I mean, how could commercial plans that are your customers that are negotiating managed care agreements going to start using these data to negotiate bigger discounts? I'm not quite sure all the different ways that the data could be used, but what I encourage you to do is to be monitoring that website, keep track of it so that when it does start getting released, you're ready to run with it. OPA. So we have heard from Commander Pedley that we are going to be getting audit results, and at a minimum, we know that there are going to be a bunch of entities. It might not be all 267, but there are going to be a bunch of entities that are going to be owing refunds to manufacturers. And so what I wanted to talk about is what you need to be thinking about when those refunds start to get processed. The first is, and for the entities that were ineligible, this is a little bit easier, which is, all right, you owe a refund. What is the time period over which you owe a refund? And how is OPA going to determine that period of noncompliance? And let's say they've been ineligible for 10 years. Are they really going to require 10 years worth of refunds, or is it going to be some shorter period of refunds? And most importantly, and this is sort of my strange bedfellows comment that you'll hear as we go through it, now that the covered entities are going to be subject to refunds, just like manufacturers have been doing some refunds in the past, expect that manufacturers will want parity. So if there is some rule adopted about you only have to go back 3 years or 2 years or whatever for the refund, expect manufacturers to say, we want the same rule. And you have to give us a reason why there should be a different rule or why we should look for a longer period. So that's an issue that's going to have to be addressed. How are we going to quantify the refunds? Does OPA quantify it? Are they going to have the covered entities do so? And even if they do, frankly, you probably have better data. So are you going to use your own data anyway? Is your management going to require you to use those data just to validate the numbers that the covered entities are throwing your way? And another parity issue is OPA only going to require refunds where the amount owed exceeds a materiality threshold? $5, $50, $100, $500 per entity, per product, what's it going to be? And if there is such a materiality threshold, which, by the way, I think the manufacturers have supported, when OPA issued their advance notice of proposed rulemaking on the whole refund process, certainly there were manufacturer trade groups that advocated for the fact that, understand we have to do refunds, but there should be some materiality threshold when we have really small dollar figures, the price or the cost of generating those refunds exceeds the value of the refund itself. Let's come up with some reasonable threshold for that. And it definitely could work both ways for covered entities as well. Last but not least, what if a manufacturer doesn't want to recoup? And this can happen for a lot of reasons. One is materiality. So even if a refund amount exceeds a materiality threshold, so let's assume OPA adopts a materiality threshold, it still might be something that isn't enough for manufacturers to care about, and so you don't want to recoup. But frankly, and more likely, is they're a really good customer. One of the biggest reasons I've heard from manufacturers about why they don't want to audit customers is because they're their customers. I will tell you that if that's your position, then you need to stop complaining about compliance, because if you're not willing to audit your customers, then you really shouldn't complain about how they're really non-compliant, because that's really one of the tools that you have to use. But it may mean, okay, I'm not going to audit them, or I may audit them or whatever, but I don't want them to have to pay me back. And there are some really significant legal issues that OPA doesn't control. So I'm glad to hear that they're working with CMS. I hope that they're also working with the OIG, because the anti-kickback statute could be read to suggest that forgiveness of that debt that otherwise would have to be refunded under whatever OPA guidelines OPA adopts, if you forgive it anyway, that could present a kickback issue. And so we need some guidance from the OIG about under what circumstances you still wouldn't have to pursue that. And then we also have the best price issue. I mean, obviously they're working with CMS, but the issue is, what if we forgive it? Does that mean that we know they were non-compliant, we didn't get the discount back, and so we now have a discount out to an ineligible entity that we didn't count in best price? Do we have to go back and restate our best price to deal with that? Now, what's interesting about these two issues is I actually think interests are aligned. I think manufacturers and covered entities in OPA will probably all want to find solutions to those problems. And while people might quarrel where that solution should be, it benefits everyone to have very clear guidance about it so that we all know what the rules are so we can live with them. The risk arises when we don't have clear rules and we have to make decisions that then other people can criticize or suggest are non-compliant. But these are issues that I don't know how far ahead of them you can get before you know what refunds are coming, but these are issues that we will have to resolve once refunds come, and we might be hearing about them as soon as this fall. OPA audit results, implications for other policies. So I do want to take the time to say that it is great that OPA is doing this. I do think you have to realize that if you within your organization had to do all of the same sort of extra work that OPA did with no additional resources, why you would feel proud of that as much as OPA does. I will also say that it's unfortunate that it's taken this long. I don't think that anything's changed in the program. It's just nice that OPA has finally done it. And what I think people aren't necessarily expecting is how these audit results could implicate other policies, future or past, that OPA may have. The first is the orphan drug proposed rule. That's the rule. Remember, there's an exception to the 340B ceiling requirement for orphan drugs for the new entity types added by the ACA. OPA's proposed rule said that that exception should apply only to the orphan drug when used for the orphan indication. That proposal clearly assumes that covered entities can track and trace how each and every orphan drug unit is used in their hospital. Now, having gone, or their facility, having gone to the 340B conference and listened to some of these facilities, some of them are small enough where they actually might be able to do that. They don't have that many beds. They know who their critical patients are. They really track their drugs, and so they might actually be able to do that. But I think they're the exception rather than the rule. But that clearly is the underlying assumption of making this proposal work. Well, if OPA goes out there and they're finding people don't even have anything in writing about what their policy is, that they don't have the controls over even inpatient and outpatient controls, how can you possibly move forward with a proposal that assumes a much, much higher level of compliance, and not by existing entities? Remember, this applies to the new entity types. So these are the new folks in the program, and that they're going to have that level of compliance that may be factually impossible, but certainly is questionable if the audits find widespread compliance issues. Next, the non-discrimination policy. Remember that from early in the program, it has been OPA's position that basically the 340B program is an open spigot. That if a covered entity comes to you and asks for the discount, you have to give them the discount, and you have to give it to them as much as they want. And you can't say no. You can't say no even if you suspect noncompliance. If OPA comes out with audits that show, which we expect, it sounds like we might have, that there really is a problem with compliance, that there's a lot of work to do with covered entities, I question how strong that policy can continue to be. Because it basically is telling manufacturers, you assume all the financial risk for compliance because you must continue to offer that discount even when you suspect it's problematic. And you must assume that risk of noncompliance even when we know noncompliance exists. And I think early in the program, really out of ignorance, there was an assumption of widespread compliance. We obviously know now that that's a questionable assumption, at least current day. So I think that's an issue that also could be implicated by the audit results. 340B audits. This is something that Commander Pedley covered already. I will say, I think the reason that there now have been 3 audit plans submitted is that the manufacturer audit process is incredibly cumbersome. You have to hire a third party. You have to create an audit plan, and you have to create an audit plan, and the slide just walks through all the different things you need to do. You have to create an audit plan that talks about auditing something that's never been audited before. And it's really hard to figure out how to write an audit plan when you don't quite know what you're looking for. And that makes it very, very difficult. And as, which I will make clear, and I know Commander Pedley has said on other cases, what's very clear for manufacturers is that you don't get to audit eligibility, you don't get to audit the GPO prohibition, you don't get to audit the dish percentage. That's what the recertification process is about. You only get to audit patient definition and duplicate discount compliance. So why haven't been there more audits? It's burdensome. And their ramp-up costs. I mean, I think anyone who's actually thought about this at a manufacturer has said, okay, if I have to hire an independent auditor, that means it's going to cost money. And I'm going to have to go to my management and I'm going to have to say, can you please front $50,000, $100,000, $150,000 for us to audit something where there's no guarantee of recovery and we're auditing a customer who may not like us very much when we're done. And that's a pretty hard sell, right? It's a pretty hard sell. And so I think that's the main reason why manufacturers have been slow to do this. I will say, I agree with Commander Pedley that once we have some OPA audit results, once we maybe even see manufacturer audit results, it's unclear whether those will be released, I really do think that that will precipitate more and more manufacturer audits because there will be an example to follow. There will be a guide that manufacturers can use to go forward. And more importantly, you'll be able to go to your management and say, other people have done this, so we're not the first. Other people have been successful, and they've probably had a return on their investment of multiple fold when you think about how much money they recover. And so I really do think that once that happens, you may be thinking about doing an audit as well. So what is your 340B plan? And I sort of apologize for those of you who had to listen to me yesterday because you're hearing a little bit of the same thing, but that was, I talked a little bit about this at my 340B session yesterday. If you are not actively monitoring your 340B contract to the same extent that you are monitoring your commercial agreements, you are doing your company a disservice. I think for a very long time, this was a program that was under the radar at most manufacturers. It was a government program you had to do, so you really didn't pay attention to how much in discounts was going out the door in this program. You absolutely need to start doing that now for a lot of different reasons. The program's expanded, the discounts gotten bigger, your margins have gotten smaller overall. And more importantly, if you're monitoring your commercial agreements, why aren't you monitoring this? So what is your plan for monitoring this agreement? Are you looking at 340B sales patterns to identify possible instances of diversion? If not, why not? Are you looking at Medicaid rebate utilization and the Medicaid exclusion file to identify double dip violations? Are you looking at how much complying with the penny pricing policy is costing you, as opposed to looking some other alternative? Are you actually looking at these policy releases that OPA has issued and said, are these binding on me? Are there reasons why they may not be binding on me? And talking to your lawyers about that. These are all really good questions that you need to ask. And if you aren't doing them, no one at your company is. And the concern is that as a default, your company's just taking a pass on 340B. The assumption is it's not costing you any money. It's fine if after you look at it, you reach the conclusion that it's not worth the effort to monitor because the volume isn't that high, because the discounts aren't that great, you have bigger fish to fry and you're going to put your resources there. But then it's an affirmative decision by the company as opposed to a default decision based on an assumption of materiality. And that's what I really exhort all of you to do. And some manufacturers really are actively monitoring these programs. And when they do, they inevitably find issues where they can seek recovery, or they just, as a business matter, are smarter about this program. And so that is really something that you should be making affirmative decisions about as opposed to default decisions, and making sure that the relevant levels of your management are involved in that evaluation. And last but not least, never lose sight of your own compliance obligations. It's great to see all of this effort on covered entity compliance, but you have compliance obligations as well. So Commander Pedley mentioned that there are some manufacturer audits that could be coming. What are you going to do if you get that letter? Just think about it. Like, spend half a day saying, what would I give if I was asked, look at the guidance that OPA has put on their website about what covered entities can expect to get if they're out audited. Think about what that might look like if you're a manufacturer, and just as a pop quiz, what would I have to give them? For my 340B price calculation, it's not a hard calculation to do, but as a manufacturer reminded me yesterday, it's not a hard calculation to do. It's your AMP minus your unit rebate amount. But what documentation do you have to back that up that you could provide the auditors to document how you got to your price? Have you launched any new products? If so, have you complied with OPA's guidance on estimating ceiling prices for new products? What is that policy? For how long do you have to estimate the price? How do you go about estimating that price? What have you done? Are you paying ADAP rebates for rebate option ADAPs? And what does that documentation look like? Have you made any refunds to covered entities or done credit and rebills with covered entities? What does that documentation look like? And also, on the flip side, if you haven't done refunds because it's a routine restatement of AMP and best price, and your view is that that does not require a refund, and that's a view I think that you can find support for in OPA's guidance. But if you haven't done it, why? And do you have that written up so that you can provide the auditors? Because if you think about it, the auditors are going to come in and presumably they're going to ask you for your AMP and your URA. And if that AMP or URA doesn't derive the ceiling price that you used, because the current AMP and URA that you give them is the AMP and URA that you've restated for late arriving data, they're going to say, well, why don't they match? And you're going to say, well, because it's a routine restatement or whatever other reason you have. And you need to be prepared to answer that question for them. More generally, what compliance documentation and support do you have? Have you documented what your position is on all of OPA's releases? What your position is on penny pricing? What your position is on non-discrimination and on limited distribution networks? Have you documented how you determine covered entity eligibility and maintaining that list? Have you documented how you validate chargebacks and do credit and rebills? And have you ever had communications with covered entities? Have you documented those? Those are the things that came to my mind within 5 minutes. And those of you who are out there need to go back and say, what do we have? So that you would be prepared if that came about. And that's it. Me with shorter hair. And I think we have about 5 minutes for questions. Anyone? I don't know that block grant is inconsistent with a rebate formula, or at least an opt-in to a rebate formula. So I'm not sure that those are entirely inconsistent with each other. But really and truly, I have not thought a whit about that beyond that point. Yeah, and what happens to 340B? I will say the one thing I have thought about is that if Romney does repeal health reform, I think manufacturers are going to feel like, hey, we're paying a lot more money for a program we're not getting. And so I would expect that manufacturers would push back on the increased rebates depending on how material any repeal of that is, and push back on maybe any expansion to 340B, because the idea is we did this because we were going to have more insured patients, and if we don't have more insured patients, we shouldn't have to be paying more. I think what's going to be really interesting is to see how many of the audit results relate to patient definition violations. I wouldn't be surprised if it is hard to find patient definition violations because of the breadth and vagueness of the definition. And I think that will be very telling, because it could be that OPA is out there, and I'm totally speculating. I'm not even going to look at her when I say this. It could be that OPA is out there and they're seeing stuff they don't like, but they can't do anything about it because the definition isn't explicit enough to prohibit it. And so that's really going to be what tells us what that definition is. When those audit results come out, how much are about ineligibility, how much is about duplicate discount, how much is about GPO violation, and then how much is about patient definition.
Okay, one more question.
Awesome. Thank you.
Thank you very much.